So let's talk a little bit about buying power with options trading. What is buying power? Well, buying power is the amount of money that the broker requires for me to have in my account before they'll let me open a position. For example, if I go and buy a call or sell a put or whatever option strategy it is that I'm trying to employ, that trade will have a certain dollar amount associated with it. That's the buying power, right? So that is the amount of money that the broker says, hey, I have to have that amount of money freely available in my account right now before we'll allow you to open that trade. So if I go to our trading platform here, I'm using TASTYTRADE. Let me go to Apple because I don't currently have a position in Apple. Let's go to the options chain. I'm going to go to the 45-day cycle. As an example, I'm going to buy the at the money call. Now, when you buy options, the buying power reduction is always easy to calculate because when you buy an option, you have to pay a debit, obviously, because when you buy something, right, you purchase it, you pay for it. What is the buying power reduction on this long call? Well, it's the debit that I pay for the trade. So in this case, this particular call has a cost of $10.10. Now in options pricing, everything is times 100 because this option represents 100 shares of the underlying stock. So really, if I'm paying $10 for this option, I'm really paying $1,000 is the price. It's actually $1,005, right? 1005 times 100. And that is the buying power reduction on the trade. It's the amount that I have to pay for this trade. If I clear this out and instead buy the at the money put, this at the money put cost me $725. That's $725. So what is the buying power reduction on the trade? $725. This is very easy when you're buying options because it's always whatever I have to pay to purchase that option. That's the buying power reduction. Nobody ever really gets confused with long options. Where it gets confusing is short options. For example, maybe I sell the 22 Delta put here. And this particular put, I get a 284 credit. So I get a credit of $284 credited to my account. But there's a buying power reduction associated with this trade. Even though I'm getting credited $284 to my account, I have to have $4,100 available in my account that's not already tied up in any trade. There has to be $4,100 of cash sitting in my account right now that's not in any way tied up with anything else for my broker to allow me to sell that particular put. Now, why is this? Why am I being forced to have this $4,100 in my account for a trade that I'm getting paid for, right? I'm receiving a credit of $284 on the trade. Why do I have to have this money in my account? It's because this trade, even though it's a credit trade, there's real risk. What happens when this trade goes against me? What happens when Apple falls in a big way? I stand to lose several hundred, possibly several thousands of dollars on this naked short put because a naked short put has unlimited risk potentially to the downside as Apple falls. And the broker has calculated that in 95% of all losses, $4,100 should cover those losses about 95% of the time. So that is what the broker has assigned as the buying power on this trade. So I have to have $4,100 free in my account right now to open this trade. And then as the trade goes on, I still need to have that $4,100 available in order for me to be able to maintain the position. If for whatever reason I use up all of my buying power and I no longer have the $4,100 of capital needed to maintain this position, what is going to happen? Well, the broker is going to issue us a margin call. It's going to say, hey, you don't have the buying power to maintain all your positions anymore. They're going to trigger a margin call and they're going to basically force you to start closing some of your positions to get your buying power back under control. So the reason I'm making today's video about buying power is because you really need to start thinking about buying power in terms of return on capital, return on investment, right? You need to make sure that your trades, when you're tying up whatever amount of money you're tying up for whatever credit you're getting, especially with short options trades, does it make sense? Does it make sense to have $4,100 tied up for a trade where you have the max profit of $283? And for me, this is just an example trade, but I will tell you, this is not a trade I typically would take. For me, and this is just numbers that I arbitrarily pick, but I like seeing somewhere around 10 to 1 as far as a ratio of risk reward. When I say risk reward, I'm talking about the buying power reduction on the trade, because that's what the broker considers your risk on the trade, right? Because it should cover losses 95% of the time on this particular trade. So I want to see risk of a 10 versus 1 on the reward. And in this case, we're not quite there, right? This is not great. This is kind of high buying power reduction. Actually, this is higher than normal actually on Apple. I trade Apple quite a bit, and I don't remember seeing their buying power reduction being quite this high. And I can show you some other examples of this. Let me go to AMD, another stock I trade pretty often. And right now it's trading at $218 a share. If I go sell the 20 Delta put, I get a credit of nearly $5. $4.95 is the credit. The buying power reduction on this trade is only $1,900. That is fantastic risk reward. I'm basically getting like a 5 to 1 ratio as far as risk versus reward. So this, if I was looking for a trade where I wanted to be bullish and I wanted to sell some puts on some tech stocks, this particular trade in AMD looks really juicy to me. And let me clear that out. Let's go take a look at Nvidia, which is obviously in the same kind of space as AMD, a semiconductor stock. Right now, Nvidia is actually a cheaper stock than AMD. Nvidia is trading at $182 a share. Let's go sell the same 20 Delta put. I'll go 19 Deltas in this case, and I get a credit of nearly $3, $2.99, $3 credit on a buying power reduction of $3,400. That's a little worse than 10 to 1. But remember, the AMD 20 Delta put, I got like a 5 to 1 ratio. So if I was in a situation where I wanted to be bullish on the semiconductors and AI, and I wanted to go sell a put, maybe I only wanted to sell a put in one of these stocks, and my choice was AMD or Nvidia. Well, AMD is the clear choice. Just on risk reward, return on capital, return on investment, I'm going to go sell that 20 Delta put in AMD because it's got basically twice as good as far as the risk reward, right? That 5 to 1 ratio versus the 10 to 1. As a matter of fact, I'd probably go sell 2 of those puts in AMD rather than the 1 put in Nvidia, because I could actually afford that, right? Because the buying power reduction is almost half for the AMD puts. So I could put on more trades, and this is where buying power effect is really important, why you need to really focus on it with your trading, right? Make sure that you're not tying up too much capital in your trades, because that will be really detrimental to your overall return on capital. And that's not just with naked options as well. You need to pay attention to this when you're doing spreads. For example, let me go back to Apple, because there's not a lot of strikes on the Apple options chain. It's $5 wide strikes. But let's imagine I want to do a put credit spread. So instead of a short put, maybe I don't want the risk of a naked short option. Maybe I want to do a put credit spread. Would this be a great risk versus reward? Well, it's a $5 wide spread, so we're only dealing with a $500 spread on this trade. And I'm getting a 108 credit, and of course, naturally, that means the max loss is 392. And on spreads, typically, your max loss on a spread is the buying power reduction. So on this particular put credit spread, I'm risking about 4 to make 1. Now, is that a good ratio? Well, this will depend on who you ask. But for me, my personal rules is I like at least a 3 to 1 ratio on my put credit spreads. So I would bump this up. I would move these strikes up to where now I'm getting a 143 credit on this $5 wide spread. 143 minus 5, that means my risk on the trade is 357. So I'm risking 357 to make 143. And that is about a 2.5 to 1 ratio on this. And that is a much better ratio for me. That's what I want to risk on this kind of trade. Now, you will see some traders that go way out of the money on their spreads, like this put credit spread here where I'm selling the 12 Delta and buying the 9 Delta, right? I'm only getting a 39-cent credit on a buying power reduction of 461, right? And, of course, yeah, you've got a 90% chance of winning on this trade, but you're getting so little credit for that amount of money you're tying up. Remember, on the naked options, I didn't really like anything worse than a 10-to-1 ratio. Well, we're at worse than a 10-to-1 ratio on a defined risk spread. This is a horrible trade to me. This trade sucks. I would never put on a trade like this. I know a lot of the fake trading gurus on YouTube, some of them promote really far out of the money credit spreads and iron condors like this, but I cannot, in good conscience, have such a horrible risk versus reward on a defined risk spread. So that's absolutely not the trade I would take. Now, when I say spreads, I'm talking about one side of the trade. Now, if you were doing the other side and also doing like a 12 delta, in this case, a 14 delta call, and then buying the one above, this is an iron condor, and now you're getting 93 cents total credit on both spreads, right? Because the iron condor is a put credit spread and a call credit spread. So you're getting obviously twice the credit. You're getting 94 cents credit on a buying power reduction of 407. I don't hate this trade as bad, but for me, again, I have in my mind, and this is just my own arbitrary rules, I want at least a 3-to-1 ratio. So I got to bring this in a little bit, and probably this one in a little bit, to where I've got the 16 delta short put, the 20 delta short call, and then the $5 wings. And now I'm getting about 140 credit on a buying power reduction of 360. That's like a 2.5-to-1 ratio. And again, that's where I want to be personally on these spreads. So I already mentioned that defined risk spreads, credit spreads, debit spreads, iron condors, the max loss is always your buying power reduction, right? So it's much easier to understand buying power reduction on spreads rather than naked short options. But there is one area where you can actually improve your buying power reduction on a spread, and that is if instead of stock options, you go to futures options. For example, let's go to the MES futures, which are the micro S&P 500 futures. And I'll go to the 80-day cycle because I don't currently have a trade in this particular cycle. And let me go and sell a credit spread. I'll sell the 30 delta, and I will go, let's go 100 points wide. Now, futures are a little different than stocks. In stocks, everything is multiplied by 100, always, right? But futures, each futures product has its own special multiplier. And in the MES, the multiplier is 5. It's not 100, it's 5. So a 100-point spread is really a 5 times 100-point spread. So it's a $500 spread. It's a $5 wide credit spread, just like we put on Apple. Even though it looks like it's a bigger trade, it's actually the same size kind of trade. In this case, I'm getting $19 credit, but 19 times 5 in MES. So it's actually a $95 credit on a max loss of only $405. So if you were doing this on a stock, because the max loss is 405, the buying power reduction would also be 405. But because futures have their own margining system, they have a special margining system called span margin, SPAN, and the P in span margin actually stands for portfolio. It has a portfolio style margining system where they base the buying power on your overall portfolio, the positions in your portfolio, and the risk on the trade. And they're saying right now, if I open this trade at 80 DTE with these strikes, they calculate my risk on this trade right now is only $186. So that's all they're going to charge me for the buying power on this spread. Now you may think, wow, that's great. That's less than half of what I would spend on a stock spread, right? A put credit spread and a stock. But here's the thing. Don't get complacent about this buying power relief. It's great. I love the buying power relief in the futures, but this will change. The only reason this is so cheap right now is because there's 80 days on this trade and we're way out of the money, right? When we first put this on. But here's the thing, as this trade goes on, if the S&P 500 started dropping, the buying power is going to go up. Also, as 80 DTE becomes 50 DTE, becomes 20 DTE, as you get closer to expiration, the buying power is going to go up because the risk on the trade goes up. So the closer you get to being in the money on this spread, and as time passes also on this spread, the buying power reduction can and probably will rise on you, especially as the trade goes against you. So eventually this 186 buying power reduction could be 405. Now 405 is the absolute max buying power reduction you'll ever have on the spread because that's the absolute max loss that could ever be possible on the spread. So it can't be greater than 405, but at the start of the trade, you will get a little bit of relief on these futures options. So that is something to consider because again, the lower you can get your buying power on these trades, right? The greater return on capital, because you're tying up less money to win the same amount of money, right? So naturally, your returns are greater. It's going to make you more money in the long run, right? That could be the difference between you being a break-even kind of trader or a successful trader. Now, if you want to learn more about options trading, check out my book, The Super Wheel Option Strategy. This book is available on Amazon. This book is about my favorite option strategy, which is the wheel option strategy. You'll find a link to the book in the description below. Peace, guys.